What's going on, everyone? Welcome to the Capitalize podcast. Chris and Grant here, and as always, this episode is brought to you by our private lending company, Sharper Capital Partners. You can learn more about us and what we do at sharpercapitalpartners.com. If you're watching this, you can see that my AirPods died, so I'm wearing the big headphones today, so it means we're serious. But obviously, we've experienced a lot of changes in the real estate market since interest rates have started going up at the beginning of last year in 2022. And so Grant and I just wanted to sit down and have a conversation about what we're seeing on our end, you know, having a pulse on the market, talking to investors every day, and talk about it from the lending perspective and just kind of go through some data. So Grant, if you want to start this off.
Yeah, absolutely, Chris. You know, it's one of those things where we end up talking about it every time we're working with a real estate agent or even sometimes talking to, you know, various clients or insurance agents that we're talking to. And it's always going back to, you know, where do we think this market is headed relative to where we are now? And, you know, for those who don't know, you know, what markets we serve, you know, we're primarily focused in Ohio markets, you know, so that could be Cincinnati, Dayton, Columbus, Cleveland, and Northern Kentucky as well, and case-by-case basis in Indiana. So it's a weird situation where inventory is still relatively low, especially in the Cincinnati market. And we're, you know, trying to anticipate when inventory will let up. And we've had conversations with various people who are tracking different things, whether it's foreclosures or you know, things of that nature. So overall, we're just trying to keep a pulse on things. And I think that's, you know, the breadth of what we're going to be covering today.
Yeah, I think it's an interesting time. A lot of investors that I'm talking to say that it's getting harder to find deals that make sense. And I really think the best way to highlight this, because there was a report that just came out from the Ohio Realtors Association yesterday, and it talked through some of the numbers, and I think the numbers highlight this pretty well. So I'm just going to talk through a couple of these. Overall, the headline was sales activity across Ohio housing marketplace slowed in February, while the average price continued to rise. And I think right there in the headline, that kind of shows you why things are so weird and why it's harder to find a deal, because there's less transactions happening, but the price is continuing to increase. So if we talk about some actual numbers, home sales in February 2023 reached 8,032 units, and that's a 13.5% drop from last year in February. But the average sales price across Ohio reached $245,000, which was a 4% increase from last year, which was $236,000. And it just, if you take a step back and think about this, Grant, it doesn't make a ton of sense, especially when you think about interest rates rising. But I think to your point, a lot of this is driven by inventory, at least the price increases.
Yeah. It's one of those things where, you know, investors are out there seeking opportunities in the marketplace, you know, and you know, the people who, you know, what's really controlling a lot of the inventory is the interest rate environment that we're in right now. And it's crazy because a lot of people are sitting on interest rates at, you know, they might have gotten in the high 2s or even, you know, low 3% range, even 4%. And so for them to reapproach the market with the asset they have, even as an investor, you know, who, let's say they bought a property with an FHA loan and, you know, so they have a very competitive rate, you know, if it was prior to basically, you know, last summer, 2022, it's hard to trade up in assets because the debt structure behind acquiring new real estate is not the same. And so, you know, everyone that I'm talking to is kind of just, they're waiting to see when asset prices will change, because at the current rent rates that are out there for some of these assets, it's not warranted in the price that's being marketed. I think one of the hard things for people to accept is, you know, we kind of earlier, you know, in with, you know, platforms like BiggerPockets, they would be marketing things like the 2% rule, and then it became the 1% rule. And that had a lot to do with people understanding leverage and accepting lower rates of return, cash on cash, while assuming, you know, there'd be some appreciation that might make up the difference there. But now it's come down to, we don't know what appreciation is going to do. And the cash flow on these alone doesn't support, you know, the prices that people are going to have to pay with the debt they're going to have to take on at those interest rates. So really interesting time for real estate investors, inventory, home pricing. Yeah, it's just a very strange market.
And I think if you kind of flip that and you think about the rent that people are going to have to pay from the retail side, there's a ton of people sitting on the sidelines, and we hear this from our agent friends as well, where to your point, there's so much uncertainty and the interest rates kind of rise and now they're kind of stabilizing a little bit, but people got so used to a 3% interest rate or mortgage rate environment on a 30-year fixed, which if you think about it, historically is unheard of. It's basically everybody's calling it nowadays. They're calling that free money. And so now we're in, between 6 and 7. Again, this is March 22nd of 2023. But a lot of people are continuing to rent, even the people who have the income and maybe the savings to support their first time home purchase, or maybe it would be their second. Maybe they had a home, they went to renting, and then now they want to look again. But I think our agent friends work with a lot of first time home buyers on the retail side who are sitting on the sidelines, waiting to see what interest rates do and waiting for home prices to fall. And I do think that time is going to come. But again, how do you foresee when that time comes up? And it's just hard to say.
Right. And we know, there is new housing supply coming onto the market in terms of, home construction, but it doesn't seem like that's going to be the solution to the inventory problem that we have. I mean, I think the number is like 4 months of housing is typical, is like the normal. And then we're at like 1.5 months of inventory on the market right now in the Cincinnati, Ohio market. And so, like you said, Chris, it's like, what is going to change that? Because people don't want to sell, they don't want to sell their property because they don't want to have to trade up to a higher interest rate and for a more expensive property, most likely. And so with that in mind, it really comes down to, okay, well, what is going to force these people to sell? Because if they're not going to willingly sell themselves, what's going to force them to sell? And we do talk to some wholesalers, and they've been keeping track of, how much inventory is coming through the foreclosure side and things like that. And it is picking up, which, that means more inventory is going to come onto the market that way potentially. But, the one thing to me that seems like the big question mark in terms of how it's going to play out in terms of just like the financial ability of Americans to pay for their homes is going to be the student loan repayment coming back online. And again, that's purely speculative, right? Like everyone's going to take their claim as to what's going to change. But interest rate changes, I don't think are going to force the people who currently have their interest rates to sell because they're locked in, unless they have an ARM or something like that. But everyone else, who, hasn't accounted for, perhaps, the additional interest expense or loan repayment costs that are going to go into play once their student loans pick back up, that could be a cash crunch for a lot of people. And that could force some inventory to come back on the market. So I don't know, just food for thought there.
For sure. And I think another piece of this, and this is speculative as well, I'm not by any means an expert in the jobs arena, but you see so many tech layoffs happening right now. And you just wonder, right, is that just the beginning of something that's going to be much larger and going to permeate the rest of the market? Is this kind of a one-off? And if people start to lose their jobs as the market continues to turn and the Fed continues tightening their policy, they won't really have a choice. A lot of people won't have a choice whether or not they want to sell their home because they might say, oh, well, I have this great interest rate, but it's not even, that's going to be an afterthought. They're going to be like, I need the cash right now to continue just living my regular lifestyle and supporting my family. And so maybe that's an extreme. Maybe that's further down the line. Maybe it doesn't happen at all, but it's just something to consider because I do think it's kind of hard to find how extreme these tech layoffs actually have been unless you look for it. But it's been continuous and pretty large in the grand scheme of things if you do go digging and you look for these figures.
Absolutely. I recently read a report by EPB Research. I think that's the company, or the publisher of that report. And it was talking about, okay, well, where are companies or where are markets over leveraged? And, real estate wasn't one of the markets that people actually identified, which I thought was interesting. It was on the high side, but it wasn't, in a critical state. And, coming from the CPG side, consumer packaged goods side, I want to speak a little bit to like what happened to a lot of these consumer packaged good companies over the last, 18 months really. And that is they had insane inflation to their cost of goods due to transportation costs, like 40-foot high cube containers going from like $5,000 to like $30,000. And it doesn't sound like a lot, but when your margin's pennies, the stuff disappears pretty fast. And in addition to that, you think, okay, well, what really happened there? Not only did their cost of goods get more expensive, but it also forced a lot of these companies to hold more inventory because lead times got so extenuated. The ports were backed up. If you were reading Wall Street Journal or any of the major publications, they were all coming out and talking about how congested the ports were. And that had a lot to do with the scarcity buying that was taking place throughout the pandemic. And so manufacturers and distributors and alike, all bought up and warehouse products so they could distribute to their customers. Well, now that demand is waning. Container costs are back down to $5,000 for a 40-foot high cube. And, we're in a situation now where a lot of companies are sitting on inventory that's going to take potentially a year or multiple years to move. And now they're borrowing money that's, 3 times as expensive as it was due to the interest rate hikes, because most of these companies are using a line of credit that is based off of the Wall Street Journal, Wall Street Journal plus prime. And so in conjunction with what EPB was discussing, the liquidity crunch really is probably going to come from the business sector, which factors into what you were saying, Chris, where when there's a liquidity crunch there, they have to cut expenses if they can. A lot of the times that comes down to labor. And, when people don't have jobs, they can't afford, their lifestyle that they were previously leading. So, that's another angle that I think is going to definitely play a big factor.
Yeah. And I mean, from a lending perspective, in the real estate side, we have seen, and we've talked about this before, but we have seen a lot of the liquidity dry up from a lot of the institutionally backed lenders out there. And so activity from a private lending perspective has picked up a lot, and not even just hard money, like not actual businesses, but a lot of individuals who just have cash or have money in their IRAs, they are becoming private lenders as well. So private money, I think, is becoming a hotter commodity, so to speak, because even though it is more expensive, it's available, right? And a lot of the lenders that we talk to are like, you're going to win by just being around. And I think if you think about it from an investor's perspective, it is a weird time in the market. And a lot of people who maybe entered the market in 2020, 2021, 22, when the market was hot and you could get a smoke and wholesale deal if you put in some sweat equity. Those opportunities are few and far between nowadays. And so a lot of people are exiting the market. So if you're an investor and you're looking for a way to take down a deal, I mean, you're going to be on top just by continuing to play the game and playing it safely, but also finding access to, maybe it is private money, maybe it's a little bit more expensive, but you'd rather get the deal done and maybe make a little bit less and not get a deal at all, right?
Yeah, exactly. I think, you kind of hit the nail on the head of, there's less transactions taking place, certainly, but especially with the capital supply that's starting to get a little constrained. We see the institutional backed lenders, some of the big note buyers, there might be originators for loans and then they have to sell it off to a secondary market. Those markets are going away. And so a lot of these huge lenders out there, the big national lenders that we all know of, and not going to say their names, but, they're having to make a tough decision of, okay, can I really continue going this institutional route, or do I have to raise my own private capital? And some people are making the jump and some aren't. Some are just closing up shop altogether or closing that part of their division, that lending portfolio that they've had. And it really is going to be interesting to see what happens to private capital over the next, 18 to 24 months. Like you said, because it's there when, the other institutional markets aren't. And right now those markets don't make as much sense as private capital, just to be frank, because the rates at which they have to borrow at relative to the fees they have to charge to run their operation, it just doesn't work. And, we're over here on the other side of the coin going, this is great, but in reality, it's leading to deals that are not getting funded at the closing table. And, we're having to come in and rescue some of those deals when we can. And those are the good situations, but the bad situations are when great deals go on, or the worst situations when great deals go unfunded. So that's why right now we're stressing to all of our clients, like even people who have, said, oh, I can get money at these terms somewhere else, check again. And there's no reason not to have as many backup sources of capital, because let's face it, if your deal is good enough, it really doesn't matter what realistic, in the world of realistic financing options you're going to use, you should make a healthy profit. And I can't stress that enough to clients right now. And everyone we talk to, it's like, do not just say I have capital when you only have one source, because that one source disappears and then all of a sudden you don't have capital.
For sure. And I think especially in an environment like this, when there is so much uncertainty, I think this is an environment when you can really come out on top if you do things the right way. And I was having a conversation with somebody this morning, and to your point, there are still options out there, especially private money, but not all private money is the same. And you still have to have the same considerations when you're considering private lenders as you do when you're considering institutional lenders. And is that money going to be there when I absolutely need it? Something we say to our clients all the time is we're happy to be your second option, because first and foremost, we want to make sure that you get your deals done. But at the same time, we also want to make sure that you're getting deals done in the right way, right? And we're not necessarily there to tell you how to do that, but just to kind of have that conversation and at least be a sounding board and talk through the details to make sure, okay, if you're getting 100% financing for this deal, is it the right move to do that? Are you trying to scale your portfolio? Are you trying to buy 30 properties this year and you want to use 100% financing for all of them, or maybe just 10% down for all of them? Is that actually setting you up for success? If the market does something that you don't expect, are you safe? And it's a hard conversation to have, especially when things have been going so well. But I think that's where kind of taking a step back and looking at things at a more grand scale, kind of a high level view, and saying, okay, things are cyclical. Things aren't always the same as they were before. And you want to be making the right decisions in the short term to set yourself up for the long term.
Yeah, it goes back to places like Silicon Valley Bank and Signature Bank. And, in their instance, when those companies, from the time those companies were formed to the day they, had to close their doors and were insolvent, they never had to learn how to survive interest rate risk. They just never had to. Similarly, real estate investors that have blossomed over the last 10 years do not know what it's like to go through an environment where there's depreciating asset prices or asset prices that don't appreciate. I think we were sitting with one of our good friends, real estate agent here in the market, and talking about, asset prices in Cincinnati, Ohio have appreciated combined 60% over the last 3 years. And that's not typical. That is so far out. If you look at your standard returns on appreciation for residential property, that is about as far out on the spectrum. It's got to be the fifth standard deviation, in terms of what's possible. And so we can personally attest to, we've funded deals where they were going to be tight for the rehabber, but they ended up coming on the other side because, lo and behold, it was a tight inventory market and interest rates were low and people were happy to come in and pay a premium because the payment wasn't all that different. And those days don't exist anymore. But right now people are fighting tooth and nail to hold on to what they have. And it's only a matter of time, assuming the economy does slow down, that inventory will change, because it'll just have to. But in terms of, like you said, Chris, people going out there and, seeking capital, there's a lot more that goes into funding these deals than, just how much cash you have to put into it. And although that's a super important component, you want to try and put as little down into the deal as you can. It doesn't do you any good if, you don't have enough capital in the deal or enough cash in reserves to get yourself out of situations when the market doesn't move in the way that you anticipated. And so we're underwriting conservatively. We're being forthcoming with our investors about, the possibilities that this market could lead to. And depending on who you talk to, it could be a minor depreciation period, could be a larger one, it could be, static prices. But yeah, if anything's for certain, it's not going to look like it did over the last 3 years.
Definitely. So real quickly, I do just want to kind of run through a couple of these numbers here, and I'll talk about Cincinnati, Columbus, Dayton, and then Northeastern Ohio, just kind of what the numbers look like, because I did talk about high level Ohio as a whole earlier. So if we talk about number of units sold, out of those 4 areas that I just talked about, Cincinnati had the largest change from February 22 to February 23, and it decreased by 23% from 1,600 units to 1,200 units. Columbus decreased by 11.5% from about 1,900 units to about 1,700 units, roughly. Dayton decreased by 8.2% from about 1,000 units to about 900 units. And the Northeastern Ohio area, it's not specifically Cleveland, it's not specifically Akron, it kind of bundles this, at least in the numbers here, decreased by about 13% from 3,200 units to 2,800 units. So obviously, real estate is regional. Different areas are impacted differently. And if you look at the stats for something like San Francisco, California, I'm sure those numbers are much more drastic. And to your point, after the Silicon Valley Bank and a couple of these other bank failures took place, I actually read something about people putting in employment contingencies in their offers, and financing contingencies are coming back much more strongly. In 2020 through 2022, there were no financing contingencies going on. I mean, how could you make a competitive offer in that environment with a financing contingency? And obviously that's an exaggeration. They still existed. But now there's things like even employment contingencies saying, hey, this offer is contingent upon me still having my job when the offer is accepted. So seeing some crazy things, that's kind of a tangent. But I just wanted to break down those numbers because I think it's interesting to see, Cincinnati had double the decrease in number of units sold compared to Columbus or Northeastern Ohio or Dayton. And so it's something to take into consideration when you're thinking about where you're investing. And again, another side note here, but a lot of investors that we talk to are out-of-state investors who are looking to invest specifically in Northeastern Ohio or maybe Dayton, where they get stronger cash flow with lower asset prices.
Big time. And we focused a lot, Chris, here on like what's going on for real estate investors and what kind of what we're thinking about the nature for real estate investors going forward. We can talk a little bit about this on the lending perspective, and we've sprinkled that in here and there. But in terms of like lead volume, we really haven't seen anything slow down per se. I mean, you could argue that this past week things were a little bit slower, but from a pure numbers standpoint, from November to I guess you could say February, like the numbers are consistently the same. And whether that's an effort of our marketing that we're doing or the fact that there's just consistent demand for private capital because of the situation that we're in, is debatable. But I kind of want to get, we talk about this stuff in the office, and that's really what this episode is all about. What do you think is going to happen? What do you think is going to happen in the private lending space?
I think it's really hard to say, but based on everything that we've talked about, based on the conversations that we have, and based on kind of the macro look that we take, I do think that that's going to continue. And maybe the lead volume as a whole goes down a little bit, something we kind of saw at the beginning of the year, but the quality of the leads is going to go up. And I don't even necessarily mean that the deals themselves for the investor are going to be smoking deals. Hopefully they are. But I think in terms of what we're going to be looking at from a lending perspective, there's not going to be a ton of options in terms of capital. And so maybe we're offering at lower LTVs because that's what we feel comfortable with, and requiring maybe a little bit more cash down. And, I think we're going to end up making relationships with a lot of investors who come to us for, even if it's, let's say they're trying to take down a $500,000 property, they have the cash, but they just need a little bit of financing to get it to the finish line. That's where we're going to come in. And hopefully this doesn't happen, but we're already starting to see it. And you touched on this, Grant. I do think a lot of deals, we're going to be closing a lot of deals on shorter timelines to help people get to the finish line. And I mean, that's kind of our strong point. So we're happy to do that. But in terms of lead volume, it's hard to say. What do you think?
Yeah, I mean, I agree. I think the lead quality is definitely up. In terms of deal quality, it's like, it's hard to say. Like, I don't see, we see people who are going out, and we've seen solid deals over the last, 3 or 4 months for sure. We've seen solid deals. We see more base hits than we see home runs. And I think that's sometimes hard for people to accept, because the deals that get talked about most of the time are either very, very good or very, very bad. But for most of the investors that we work with, it's like, this is a single, if you want it, swing, and you'll get on first base. Hit enough singles, you'll get a run in. And that's the same way we approach our lending. We're not out here trying to do monster loans, or trying to do as many loans as possible to fill up our pipeline. It's about doing the right loans for the right clients, on the right properties. And in terms of, where do I think the future of private lending is going? I think that we've talked to other lenders out there who aren't marketing themselves right now, because they just never really were set up to do that. And before, they were able to find deals because there were so many people who wanted to transact. And I think that while there will be demand for their capital, with transaction volume declining, there's less deals to fund. Like, that's just the truth of it. And so diving down and doubling down on our marketing efforts right now is going to be so big for us maintaining a strong point and continuing to maintain the lead flow that we already have. Because, if we keep the same loan production we've been doing over the last few months, like, we'll be happy with how we produced over this past year. And I don't know if that can be said for everyone else, if they say, oh, if I have another March, or if I have another February or December, I'm in big trouble. And there's a lot of vendors out there right now, whether it's real estate agents, contractors, title agencies, what have you, that I'm sure are feeling the same way. But fortunately, I think the biggest thing we have going for ourselves is that people know who we are, and we do what we say we're going to do. And we definitely don't oversell ourselves. And, we do what we get in front of clients, and we keep our promises. I think as long as we continue to do those things and keep up with this marketing, we're going to have plenty of lead flow. So,
yeah. And I think to your point, a lot of times it can be a little bit, sometimes you take a step back and you think to yourself, is there something I could have done differently during this conversation with an investor who's giving us a call to have won their business? And, it's hard to tell without having a direct conversation with them and saying, hey, why'd you go somewhere else? Or, hey, we closed a deal with you. What made you choose us rather than somebody else out there? Either way, I think sometimes investors are trying to turn these base hit singles, right? These singles into doubles by putting less money down or by putting no money down and going other places. And it can be, I can't blame them, because even from a lending perspective, we want to write loans. Sometimes it's like, oh, this deal's a little bit tight, but we could do it. But are we setting up the investor for success? Are we setting ourselves up for success in the long term, like we touched on earlier? So I agree. I think our clients who we work with, who are really savvy investors and who are doing things the right way, maybe they're hitting singles, maybe they're hitting the occasional double, but they're not overextending themselves to a point where, maybe they hit a home run, but that home run has the potential to take out, the rest of the RBIs that they've hit in the past year, or would potentially hit moving forward had they been a little bit more conservative. It's a hard conversation to have with people. And sometimes, we even see it ourselves, wanting to maybe potentially reach a little bit too far and having to say, okay, let's make sure we're setting ourselves up for success. But I think it's those lenders, kind of back to the topic that you were talking about, it's those lenders who maybe sacrifice some of the short-term wins, I'll put that in quotes, to be able to set themselves up for the long term that are going to end up coming out on top, so long as they're able to put themselves in front of other people and other people know they exist.
You know, Chris, you kind of flirted with this idea, and it really is like resonating with you right now. And I want to reiterate it to anyone who listens to this, who is an investor, who's, you know, seeking private capital. And, you know, just because a lender will fund your deal doesn't mean you have a good deal. And I want to go a step further and say, if they physically don't walk the property or do any sort of like appraisal or underwriting on your property, then all the underwriting comes back to you. Like, you know, it comes back to, did you get it right? And there are people out there who will do stuff like that. We don't, because we're lending our own funds along with our private investors. And quite frankly, like, you know, we always say this, but if I wanted to write non-performing loans, then I wouldn't. I would just go buy the non-performing loans, right? We want to write performing loans. And so we want to go in and look at a property and make sure that, hey, this is a good deal. And we have transparent conversations with our investors all the time. Like, hey, look, this is how much we think you're going to make. You know, we're not experts. This is what we think you're going to make. And, you know, here's what your return is going to be on, you know, whether it's like a rental or a fix and flip. And, you know, people don't love to hear, you know, what we have to say sometimes, you know, because it's like, you know, they want to draw their own conclusions. But I can't good faith go into a project like without telling someone, you know, hey, this is where how we think this project is probably going to play out. And, you know, a lot of times it winds up that clients, you know, do the deal anyways, and they bring cash to the table that makes us comfortable. And, you know, they end up in a better situation than we could have imagined. And those are great. Those are the best situations. But at the worst situations, they arrive at usually where we're at. And I have an example of, you know, there was a client who had a property and, you know, the property needed some work, and the ARV that I arrived at was a little more conservative than they had anticipated. And so, you know, they were a little bit, you know, they kind of like, you know, okay, well, is that really where you think it's going to be at? Because if so, like that would change like my decision. And all you can do is just be transparent. And we get second opinions. We have real estate agents look at the deals that we look at, pull comps. And so we're never alone on the decisions we make or the conclusions we draw, because we have to convey those loans to the investors that, you know, invest in our deals. And so I just want to reiterate that just because someone is willing to fund your deal, even at, you know, a high LTV or with low money down, that doesn't necessarily mean your deal is a great deal or a deal you should do. So make sure you do your underwriting. And if a lender wants to do more homework on your property, that doesn't mean it's a bad thing. It just means they're trying to, you know, make sure that the loan is going to perform in its base case. So, but
yeah, I totally agree. I think the more eyes you get on it, the better. And the more perspectives you can see an investment from, again, the better. And that's exactly why we do the third party opinion, why we get somebody else who might have a different perspective on the market, who sold something down the street just a couple months ago. You know, we want those people to provide an opinion, because we don't want everybody has the potential to miss something, right? So you just want, you know, the more opinions you can have, the more valuable and the more sure you can be that you're walking into something that you really want to be a part of, and that, you know, maybe you still walk into it, but you make a couple of adjustments and make it work. Whether you're going to flip it, maybe you're going to hold on to it as a rental. You know, I talked to Rob Speckert the other day, who's an agent up in Dayton and Cincinnati, and he's like, there's a million ways to exit a deal, and you can pretty much always find something that works, but it's having those conversations to make sure that you see all angles. But that's all I got. Is there anything you want to wrap up with, Grant?
No, that's the gist of it, Chris.
Awesome. Well, I appreciate everybody tuning in. Again, if you want to check us out or you want to get in touch, we'll leave some information down below, or you can go to sharpercapitalpartners.com, and we'll see you in the next one.